Yes, let's take your $15 million and invest it into real estate, which I don't really understand. And it's gone. And it's gone. 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 Gone.
Brandon Turner, a prolific podcaster, previous host of the BiggerPockets podcast, founder of Open Door Capital, a $900+ million real estate company.
In order to be able to do that, I'm going to have to be the Dave Ramsey of real estate. The majority of the world, they live in this belief that their life is the result of luck, of circumstance, of external factors. They're in the back of some taxi getting driven around by some drunk taxi driver going wherever the taxi driver wants to take them. But I want you to know that you are the driver of your life.
Well, good afternoon, everybody. Welcome back to an impromptu industrial real estate show. Please be joined by my good friend, Ron Rohde. Ron, good to see you, my friend.
Chad, likewise. I was just saying it's been too long since we've had a collaboration. So much to talk about, but what's going on in your world?
Well, a lot. And I don't know how many people will be active on Twitter or X or follow or be connected there with me, but it was a crazy weekend, an absolutely crazy weekend. I first reached out to you this weekend because I wanted to talk about the Jacob story, about a guy who bought a property, put it under contract, and then retraded at the 11th hour. And that in itself is a crazy story. But something even wilder came after that, and it's preoccupied a good portion of the last 2 days for me, just diving into this more. And if anyone's unfamiliar, it's the Brandon Turner story. And if you're active on social media or you're in the real estate space, you've probably heard of Brandon Turner or BiggerPockets, where he made his name. So Brandon Turner was started with, I don't know if he founded BiggerPockets.
He was an early employee. I saw he's not actually the sole founder, but he was a very early employee. He had equity in the company, and largely he was responsible for growing the podcast and really just exponential growth of the reach of BiggerPockets. So
thanks for elaborating on that, and feel free to add in anything or correct me if I'm wrong as I'm going through this, because my research has been sporadic over the last couple of days. And the first, I just want to emphasize, please listen to this before you invest or buy anything related to Brandon Turner. Please. You might still have the same conviction at the end of this, but I want to talk with Ron specifically and speak to anybody out there who is a potential investor of Brandon's or considering buying anything of Brandon's. Please hold off before you listen to this, because there's a lot to cover in this. And I first want to start by pumping Brandon's tires. I think he is a brilliant communicator. And marketer, brilliant communicator and marketer. And those two skills are very, very hard to come by. All you need to do is watch an average person speak and listen to how many ahs or ums or you knows or pauses or awkward breaks and flatlined response and very wandering language. That's average. I'm not even denigrating that to make it sound like that's bad. That's just average. To find somebody at Brandon's level who's such an eloquent speaker, great communicator, tons of passion, tons of energy, I commend him for that. I think that it's very justified that he built up such a big following, because he does have that brand. He's got the big beard. He's got the big voice. He talks a great game. He's energetic and exciting. I think that's fantastic. He parlayed that into the podcast, which he had then helped grow. And I believe he's got 400,000 followers on Instagram, a whole bunch on YouTube, 50,000, I believe, on Twitter before he blocked me. I can't check anymore because I'm blocked. He's a big following. He's done very, very well. And he's used that to go from being an expert in single family houses, which he promoted a lot, the Burr model and all the different techniques that he had for single family houses. He used that to leverage into multifamily. And why this has become relevant to what we're dealing with right now is that he just put out a post on his Instagram last week, a mea culpa of sorts, where he said, "I'm sorry to all my investors. I just lost $15 million of your capital." And it went on to say all these reasons why and how he's going to do better. And he wants to make sure he corrects those for the next time. And he's going to work hard. He's going to learn from his mistakes. And what got me what really got me fired up was the fact that so many people were coming out in the comments and being like, this is so brave, this is so courageous. And I was thinking, here's an influencer who's built up a very loyal and trusting following, who and I wouldn't want to say that he's been predatory on it, but he's definitely been opportunistic, where he's taken that marketing reach and what he's been able to build through his audience, and he's been opportunistic in taking them and having them invest in his different funds and different opportunities that he's doing. And to have people come out and say, oh, you're so brave for acknowledging that you just lost $15 million, it just struck a chord with me that that's $15 million of capital that wasn't his, that he lost, where he should have been a steward of it. And so I started posting about it on Twitter, and other people did as well. And it soon came out that he bought the deal at a sub-3 cap, which is crazy, a crazy valuation.
Value add, Chad. You have to raise the rents. You're going to paint the cabinets agreeable gray, put in a dog park, and raise the rents by $150 a month. That is the plan. We're going to execute it in 6 months.
There are some funny comments that I saw. One person's like, all we need to do is just model occupancy at 130%, and we're there. That's so good. The one that I wrote is like, all these guys seem to have a spreadsheet where the rent growth and the operating cost growth is fixed, and rent growth is always at 5% and expenses is always at 3% in every one of these pro formas that they do. But anyway, so we started going, and some other things came out about a rate cap, because he bought, of course, not only did he buy at a sub-3 cap, he bought this with an adjustable rate mortgage prior to the interest rates skyrocketing, which we all know that they were at historic lows. You could get super cheap debt, where in a perfect world, maybe that sub-3 cap deal would have worked if you could have raised all of your rents, kept your expenses relatively stable. It could have worked. That could have been a successful 5-10 year plan, but interest rates skyrocketed. And again, that's just to me thinking, here's an influencer who's supposed to be an expert. He's held himself out as an expert. I think everybody could agree with that. And he took the decision to buy a property at a very aggressive cap and have floating debt on it, which, as you transpire and we extrapolate out to where we are today, now it went into foreclosure, and $15 million of his investors' capital was wiped out. But he's brave and courageous for coming forward to saying that.
Well, and let me take a little bit of a nuance here, because I think he has a co-GP, disrupt equity, and it might change the type of mistake that he did, which was not so much, malicious. And I think, Chad, I'll say this, like, you're not saying that he was malicious or intending any ill harm from this, but he partnered potentially with somebody who was telling him how to underwrite, how to buy this deal, and what purchase price they should strike at. And so he partnered with them, and he trusted them. He kind of sold his credibility to his investor base, and partnered with somebody else. And in a way, that's almost worse or equally culpable, which is, if you don't understand it, you can't sell it to somebody else. And so to me, that's a little bit of a distinction between, like, he posted later, right? Like, he didn't understand the NOI. He was saying like, oh, our expenses went up, but our NOI went up. And I was like, great. I don't care what your expenses did then. NOI's up, we're good. But he was like, oh no, that hurt. When he doesn't understand it, he can't be selling this to somebody else.
I'm glad you made that distinction, because you're right. I wouldn't suggest that there is anything fraudulent with this particular deal. I hope that the investors can do a full audit of this, because
there
maybe
are lawsuits.
There is.
So I'll speak to, I guess, a couple of attorney comments of publicly filed lawsuits. And while it may not be fraud in our, the Nikola guy, the semi guy, like he was faking it. Theranos, like Elizabeth Holmes, like that's straight up fraud. But the legal standard for fraud here, it may be a little bit different if, as allegations as they hold, there were OMs stating a 70% LTV going in, when in reality they closed at 68%. That's a material amount, and I think we have the benefit of hindsight to be, yeah, 2% of leverage on a $20 million deal, like, or bigger, right? I mean, 15 million was across how much? Probably 50 million of deals, 45. So
Yeah.
but my point is, on a 70 million, that's 1.4 million. It's pretty significant. I would argue that the 2% starts to look material. It might not be the straw that broke the property's cash flow, but it certainly counts, and that's pretty significant if you didn't have that extra leverage and you would have raised more equity. Because as we know, debt and equity, they all work hand in hand. So less debt, more equity just makes it a little bit safer. So I would say that if that ends up being true, that could be the grounds to proceed on some type of fraud, because it's a material misrepresentation of the deal, and whether it's a mistake or negligence, there's no excuse.
I'm glad you mentioned that, because that's how I think on this as well, is that it is inexcusable and it's indefensible. And the amount of people that had come to his defense on social media and tried downplaying it, to me, that speaks volumes and it's all GPs that are saying that. I've had a few people message me, and they're all GPs, and I don't know if they're just proactively trying to get ahead of their own problems, which if it's raining, it's pouring somewhere else, and I suspect that this is one of many that is struggling. And I think Brandon took the easy way out on this. I think I would love to see an audit trail on what his fees were on this, on the acquisition fee. I'd love to see what his management fees on this were. I'd love to see how much he contributed to this deal himself, because he holds himself out. I think on his website, he said that he has $1 billion worth of real estate under management, presumably, but $1 billion worth of real estate. How can you be this ultra successful investor, but you're fleecing some of your investors for $15 million because you're letting a deal fail? I would think that if someone very wealthy had a deal that was just going underwater, they would just try to find a way to keep it afloat. I can't imagine the average person just going and letting their investors sink if they truly are that successful. Either that, or there's nothing under the tide. The tide goes out and you see who's swimming naked. Maybe that's just what we see right now, is we see this real estate grifter who made all of his money selling courses and his podcast, and really never made money in real estate.
No, I think that's true. And we wouldn't be surprised if you have some of these low level syndicators. I'll pick on Apple's Way down in Houston. No, nobody ever claimed, I think, that sponsor had money, and he wasn't claiming to be successful. He just said, I'm just an IT guy or a doctor like you. Give me your money. But he didn't claim to necessarily have this, I made my money in real estate, so I have some. It was just a pure roll of the dice, because that sponsor had no backing. But that's a great point. If you simultaneously advertise how big you are, AUM, that should enable a larger base of either cash flow to keep things floating, or personal net worth to save a deal, versus just giving the keys back, because some of these syndicators were 23-year-old kids, college dropouts. They don't have two nickels to rub together. They can't come up with any type of capital call.
And that's what really gets my goat, is that there's a guy on YouTube here. We'll put a link to the video, because he did a 20-minute video explaining that he was a $75,000 investor in this project. And I don't get the sense, he could be very well off. I just don't get the sense that he's swimming in millions. I get the sense that $75,000 was pretty meaningful to him. And he just goes through and explains how he thought so highly of Brandon, and he really looked up to him. He was a big fan of his. And when things started to go wrong, he even says in the video, because I've referenced this a few times, and this is the 1751 mark, he says, I just wish Brandon would have worked more than an hour a day like he bragged about, because he might have been able to fix some of these problems. And coincidentally, in one of the posts that Brandon did, he said, if I had more time, I could have kept this deal alive. So
No, he
again,
talks about working 3 hours a day. That's his like limit, 3 hours a day.
Yeah, in the video, the guy says 1 hour, so maybe it's 3 hours. But I think Brandon prides himself on not working a whole lot, however much it works out to. But if you're an investor, and again, this kind of circles back to everything that we're saying, you see this guy who holds himself out as an expert, who's very successful. And then he says in a post, if he only had more time, he could have turned this deal around and made it a success. Would you not start asking as an investor, well, why can't you float this so that instead of us losing all of our money, you help this deal along, and then we can all have a win at the end instead of just folding this up? I would just, there's so many questions that I'd be asking as an investor on things that just don't add up here.
No, I agree. I think he maybe hasn't consulted with counsel yet, or he wasn't running these tweets through a PR team, because it looks bad. The optics are bad. The facts as we recognize them, to the extent there's not a conflict. Did you also see the post where somebody claimed this property was sold, and there's like a presser saying like, oh, this was sold versus a foreclosure or deed in lieu. So I was curious if there's any proceeds. Did you see that?
I did. Yeah. I think it's sold for 50 million, if I'm not mistaken.
Okay.
So, and even the accounting on that doesn't make sense. They bought it for 72, sold it for 50, $15 million of investor lost. Where were the other losses? I would really be pushing for a full audit trail on this. Like, I would want to see where every single penny went, because it just doesn't add up to me. Even if it doesn't add up, though, I think the real heart of this case is that it's negligence. It's fraud is one thing, and that's a very serious allegation that will have to go through the court system. But I think it's pretty clear that there was negligence, and he's admitted it himself. He admitted that he didn't understand what a rate cap was. And one of the comments that I saw on Twitter, a guy said, if I had invested with somebody and they came back to me after the fact and said they didn't know what a rate cap was, I'd rather they have just stolen my money. So we're not even insinuating that this is negligence at this point. I think that there's a demonstrable case that there's negligence on this. So I wrap this all up, and let's talk. We'll shift afterwards, because the last thing I'd want to do is say that paint all GPs with a bad brush, because I think GPs, I'm invested as an LP myself in other funds. I think that there is merit to it. But with this one in particular, I think any investor has got to give a very hard look on these influencer GPs that are promoting deals, because there's a big difference between an influencer and a marketer versus an operator, and the two are not nearly the same.
Well, and I think you struck on it earlier, is what are the reasons for investing? And when you open with, you follow him, you like him, you look up to them, those are not good reasons. I would rather invest with somebody because of their track record, because of their experience in a specific market, because of their commitment, with this, because of their network of local play. Like, those are good reasons to invest with somebody, not just because they're a friend or somebody you look up to on the internet. And that's a key shift that maybe I'll open the segue. There's another very popular GP, Scott Everett, S2 Capital, wildly successful, started in multifamily, I would say earlier, ahead of the boom. So they were already buying and selling big buildings before it blew up in price. But he just poured gasoline. When his engine, went to 10,000, he just went more on the gas and was just raising more and more capital. I think he's an interesting example of a GP, capital allocator, whatever you want to call it, who was giving the keys back on buildings, wiping 100% of his LP equity, yet he emerged relatively unscathed. I think there's key distinctions, but he was still making money on net for his investors. I wish I had the statistic, but he still posted something like a 19% return for his investors, even with the 100% losses. And as Warren Buffett, a loss takes forever to recoup, but that's how much his engine really produced in terms of overall returns. And his investors were mostly institutions. So he was getting big checks. Somebody would write him a $5 million check, put 1 million, 1 million, 1 million. He even torches $1 million and 500K of that investor's money, and they're still happy because they got back 8 million. And he's like, you know what? You win some, you lose some, but you can only do that when you're playing a long-term game with that type of equity size. And so Scott is somebody that he was giving keys back to lenders on certain assets in the DFW area, and yet he was raising money for a distressed multifamily fund, saying basically, I'm the best operator. Give me 100 million. I'm going to go buy these types of properties from people like me, except not those, because those are not worth saving. And I think he did put a lot of his personal balance sheet on there, but still it wasn't enough. So what do you think about that distinction of a GP, Scott Everett, who also lights LP money on fire, yet, he's still rich. He's still raising money. I commented on your post. I think that is the hallmark in America and capitalism today is it really doesn't matter what you do. Can you still raise money?
And for GPs, that is the lifeblood. You don't exist if you don't raise money. And Brandon will find that out the hard way if he isn't able, because he's subsequently posted that he has other deals that are in trouble, that he has to, this is his words, that he has to go and post cringy posts on social media so that he can attract more investors and make more money for his courses. He's put that out in public. The first time I saw that, I was actually speechless. But he said
he's going to make 30 million from selling some calendars online and video courses, Instagram.
That's I'll never tell anyone what to do and what not to do. But I think if you read between the lines on where I stand with these guru influencers raising money, here's the problem that I have. To get back to your Scott question, I don't see as big of a problem with what he's doing versus what Brandon has done. Because for the most part, Scott is attracting big capital. He's attracting family offices or institutional grade capital that they fully know the risks of what they're doing. They'll have an internal risk audit team that is just looking at all of these under heavy scrutiny, and every operator is going to have a fail at some point. It's just a matter of time. Nobody has a flawless record, so it will happen. So I can excuse people that make mistakes, but if these big companies with their full teams of risk management looking at these opportunities and said, if we hedge over 10 deals and we break this up, there's some level of diversification there that we only need to win on 7 of them.
Yeah.
Maybe one goes completely bust, maybe 2 are even, but they'll have down to the T how much risk they're going to have in each one of these deals. Contrast that to what Brandon has done, where in theory, these are supposed to be all accredited investors. How many of them are, and even removing that for a second, you can be an accredited investor, but still not be a sophisticated or savvy investor. And how many of these people just did not understand that they were putting up 100% of their capital as a risk, 100% of the capital. And that's what I want to stress. And I've put this on Twitter now, and I will sing this from the rooftops as long as I can. As an LP investor, you are putting up 100% of your capital at risk, with the hope of earning a return that outperforms the market. What does that spread really need to be to justify the risk that you're taking? And you don't know that unless you understand the risk. And I don't think Brandon was clear at all with the risk. I don't think that there was any downside outlook.
All right, so I'll put words in your mouth. You're not necessarily advocating for greater restrictions on investment opportunities. Do you think it just really comes down to disclosure and amping up disclosure rules?
Yeah, I mean, that's a really good question. I would say that I would be a proponent of stricter requirements, because I think that there are a lot of unsophisticated and unsavvy investors that find themselves in these opportunities. And you and I've talked about this before, is that consider a small investor that's saved up $60,000 and he wants to go and buy a single family house as an investment property. And then he starts thinking, well, I got to do all this, and maybe I only make a couple $100 a month, and I've got to manage it and I have to do all this. But then he's also listening to a guru like Brandon talk about how they're doing this big multifamily project in Houston, and you can get in for $60,000. In that case, it was $75,000. That was the minimum on it, but the illustration holds true. For $60,000, now you can become part of this big syndication, and you get an expert, as Brandon has held himself out to be, who's managing and overseeing this, and you have the opportunity to invest along someone that you admire, that you've listened to and followed. That's very attractive. And if you don't fully understand that 100% of your capital is at risk and something goes wrong, in this case, it wasn't even disastrous. We didn't have an apocalypse in 2022. The interest just went up to the historic normal.
Yeah,
that's how bad things really got.
it was reversion
and it wiped
to the
them
mean, and there were a fair
Reversion to
amount
the
of
mean.
operators who were buying rate caps as long as they could. You just don't hear about them. They don't make the news because their properties were just humming along with the expected drag on expenses, but they're not catastrophic by any means. So
No, I've owned properties since 2014 now. Nothing really changed for me other than cash flow lowered on some of the rates that I had to refinance. Other than that, there was nothing catastrophic. I don't think that this was a catastrophic event for those investors. They lost $15 million. They lost 100% of their capital. Is absolutely catastrophic. But the market, we didn't go into a great recession in 2022. It was a reversion to the mean on the interest rates. So to think that things just returning to normal caused a complete and full wipeout of their investment, unacceptable and inexcusable in my mind that happened, with the investors not fully understanding that was a risk. Because if it was saying, guys, look at, if interest rates go up, we're going to take a gamble on this and things could go south really quickly. All this takes is interest rates going up 200 basis points and we might lose all of our capital. But if they stay the same or we can get some really big rent growth, we might be able to earn a 20% IRR on this. Then the investor can say, okay, I'm putting up 100% risk of my capital for a potential 20% return. I can get behind that. And I think that everybody that signs off on that went into it eyes wide open. But I just think that the system owes more to the small guy who only sees this successful influencer who owns $1 billion worth of real estate and has this unbelievable new opportunity, and it's limited time basis. You had better act now because we're only accepting the first 500. I can picture exactly how this racketing spiel went. I think that the system is doing them an absolute disjustice. Injustice. That sounds a lot more right. I had to pause. I was like, disjustice doesn't sound right. In a massive injustice by allowing this to happen with no checks and balances. And you can't do that in securities. You're not going to be able to do any of that in securities. So why are we just allowing this to happen in real estate? And these influencers just owe more. There should be a responsibility that comes with that position, not just an opportunity to take money from unsophisticated and unsavvy investors. I think they owe more to
maybe
it.
the answer is just having a larger check size, because what I'm hearing is it's not so much the level of sophistication, because I think that's introducing more tests on the investor side. I think if we focus on the disclosures, that's one thing. But if we just increase the minimum check size, and I know there's all legal ways to get around it, but in general, if somebody's writing $1 million check, and if there were 15 investors, I don't think we'd be shedding as much tears for them because they had $1 million free cash flow liquid to write. They're probably doing okay, and some loss of equity, investor equity, is okay for the markets to function. It just hurts when it's made up of 75K checks or 100K checks, where that money definitely means more to all those investors, as opposed to if it was 15 individuals that were all writing $1 million check.
Yeah, and I don't think that there is a perfect answer to how to do that. And I would say that investors do need to be responsible for their own money too. We're not running a charity here where people get out of jail free card if they make a
It's where
decision
the
that
government
backfires
gets
on
to
them.
say who gets to invest with who under what circumstances. I'm for less government intrusion, but the other countervailing concern is trust in the system. And you can't just run anarcho capitalism and just everybody fend for themselves if there's no trust in the system, because trust in the system allows people to invest in any level and know with some degree of confidence that if the person is a fraudster or does something, the legal system will catch up to them. But I think that minimum capital maybe is the answer. Index it for some inflation. But
And perhaps it's combined with a maximum of investable capital so that you can't invest more than 5% of your net investable assets. Again, I'd hate to complicate it too, because I hate government involvement in
Yeah.
absolutely anything. And the last thing we'd want to do is overcomplicate something where the majority of times, because this is worth highlighting as well, these are so highly publicized because it involves an influencer. It involves somebody with a big audience. I don't think we'd be having this conversation if it was just some random guy who put that out there. It's the fact that this is high profile. There's many, many more GPs that run the course of their lifespan until a sunset clause kicks in. That's much more common. So we're painting this as being a terrible situation, but it's really more of a warning sign that you can lose 100% of your money. In a perfect scenario, you do earn something close to the projected IRR that they have in their original memorandum. But I still have to go back to that. You are risking 100% of your capital anytime you're investing as an LP. So there's things that you need to understand. What would you recommend? Someone asks you, Ron, I want to be an LP. I have this opportunity. What should I know about it? What are some of the questions that or what would you suggest some of the questions that person should ask?
I think much better questions are experience in the market, and whether that's by asset type or geographic location. And I talk about this on my YouTube channel a lot, but if I'm an expert in Class D apartments in Jacksonville and I know every building, I've owned Class D in Jacksonville, I can buy Class D over in Orlando, and it's a 300-mile difference. But if I stick with the very niche asset type, I'm okay moving to a new geography. Versus the alternative is, hey, I've owned all sorts of multifamily in Orlando, from Class D, Class B, Class A, new construction, small multi, duplexes. I've dealt with the city. That's okay too, to trust them if they say, I haven't exactly owned Class C, but I want to buy this type of building, but I've owned everything around it, and I live in Orlando, and my investors are in Orlando. So those are the questions that I want to establish expertise. What makes you better positioned to buy this property than somebody else? And what is your competitive advantage? And if people can't articulate it and they just say, oh, well, I'm just paying a higher price, or I have better modeling, I don't believe it. I don't believe that most average GP syndicators have just better modeling, more accurate data, better predictions. I don't believe it. So that's one thing, expertise. Another is skin in the game. Every single investor wants to see the GP with skin in the game, a meaningful amount above any fees, because again, I'm okay with fees. I understand fees have to occur. There's dead deal costs, there's chase costs. You might have some overhead. That's fine. Fees are a part of the business, but is there still meaningful capital invested? And I don't want to hear too, I'm not stretched so thin. And I'm like, well, then your attention is also spread thin. I do think good GPs will accumulate money faster than the number of deals that they find viable or attractive, So I think those are two very important questions, and then even simple ones too about who's your network. Who are the people you're going to lean on if things go sideways? Because I think real estate is a very lonely uh, hobby, profession, whatever you want to call it, because it's very much by yourself. You're with your thoughts, you're with your documents, you're reviewing financials, but it's very much you operate in a silo. And so, to me, a good operator has a team, has a network of people. Chad and Ron, co-GPs. We talk to Chad. We're going to discuss this. It's we. It should be a team sport. And if you're siloed off, and I'm not saying Brandon was, but if you're by yourself, things become lost in perspective, and you might not have somebody to talk through decisions. Because I don't think that this deal was as doomed from day one. When it went under contract, maybe it was doomed, but there was a path. There were certainly decisions made over the course of its ownership that affected the eventual outcome. And if I didn't know who was making the decisions, there's a co-GP, other individuals. What does their background look like? Maybe somebody is a financing expert. Maybe somebody's the property management expert. Have all these people come together and weigh in with their observations. So yeah, I think those are three top areas that these are the questions that I would want to ask. And I am absolutely indifferent if the operator that I'm investing with has 1,000 followers or 100,000. Not relevant. I think, yes, you do kind of want to like them as a person. You want to think they're honorable. They have some internal sense of ethics, but they certainly don't need to be my buddy. They don't need to be a mentor. But the influence, they should just be reaching people through their own deals, their own actions.
Wonderfully said. And if I could add one thing onto that, and this is even more relevant today than other times that I've said this, is that the number one thing that I look for in a deal is what's the downside risk?
Cover the downsides and the upside will come. I think Howard Marks said that or something, but it's also a very good question.
I live and breathe that. And I think that that's a question to ask your GP. Very simple. What's the worst thing that can happen in this deal? And if somebody would have asked that question, and if they would have actually got a thoughtful response back, it would have said, well, if interest rates go up, we might run into some trouble. Okay, well, what does that look like?
Yeah.
Well, what does
how
that look
much
like?
And how quickly?
How much and how quickly? And if they can't give you an answer on that, immediately I would be out. If they can't say, well, you know what, I really don't see anything, I'd immediately be out, because then all that they're doing is they're focused on their rosy pro forma, and they're just rose-colored glasses for how good this could look if everything goes perfect. If they can't give you an honest answer on what the worst thing that can happen is, they just haven't even thought of it. So that'd be the first thing. And if they said, I'm glad you brought that up, this is what I see going wrong, and if it did, it'd be catastrophic. Like, this could be a total wipeout of money.
But there could also be a plan to mitigate or prolong it too. Because once you speak, once you're aware of something, then you can have a plan to mitigate those effects. And that's what I like too, beyond just being able to say, what's the one thing that could nuke this deal? It's this. Okay, well, now you've said this. What are some things we could do to mitigate it? Look, there's risk everywhere, but I agree. They didn't ask that specific question because back then there were multitudes of deals. That's that scarcity that a good marketer will try to push. Limited time offer. We're oversubscribed. You've got to commit now. The feeling that this deal is special or unique, I think, did a disservice to a lot of retail type investors, and they needed to know there's another deal. There's another deal coming down the pipe. Just be patient and don't force any investment because of some scarcity. It's a manufactured scarcity.
It is all manufactured. It's the equivalent of a lineup outside of a nightclub. They're doing this on purpose to make it look like the nightclub is busy when there might not be anybody in there. So don't fall for those traps. And I'm not pointing fingers at any retail investor that didn't ask those questions, because it was a different time. And if you are watching this and you invested in this, I am not pointing a finger at you. I don't think that you made any mistakes on this. I'm pointing a finger at Brandon. I think Brandon, as the GP and his co-GPs disrupt, they should have known this. They should have been asking these questions. What happens if the rates go up? What happens to my rate caps? What happens to the premiums on those? Those are the questions that they should have been asking. And if they get into a full probe of this, I think that there's going to be some ugly things that come out in discovery. And I think we're just at the we're at the beginning of what's going to be a long story on this, because it's not just going to be Brandon. He's an easy one to point a finger at because he wrote such a stupid tweet or Instagram post on this where he admitted to not knowing these things, and then admitted to that he's got to post more cringy content to make up for his mistakes that he admitted. I think that there's more coming though. So it's going to be fascinating to watch, but I can't emphasize enough. If you're an LP investor, you're risking 100% of your capital for an opportunity of outperforming the market. Because if you couldn't outperform the market in theory, then just invest in something safe like a T-bill or something low risk. You're taking 100% risk with your capital to increase your return somewhat over the risk-free rate.
And
that's just
for,
crazy.
Illiquidity premium as well. You put it in the market, you put it in T-bills. I can get that money out when I choose to pull it out, defined intervals, but 6 months, 12 months, I can pull it back out. You put it in real estate, you also need to get paid an illiquidity premium that's on top of that yield. And so it starts to look pretty steep to say, is this my best option if I don't have control? I have no insight.
Yeah, it's an interesting time, and this is what happens anytime there's cycles. It's if interest rates hadn't gone up, this probably would have been a great deal, and he would have wrote a book about how he's a multifamily investing genius, and it would have been a different story. But there's cycles, and sometimes things can get ugly, and I think that that's what makes a successful real estate investor is one that can last through the process. I'm a big believer in a second thing. So the first thing I always think is downside risk first. Second thing that I really believe in is that if you buy real estate responsibly and hold it for a long period of time, it's almost impossible not to succeed. You buy a property for let's say they bought that multifamily property for $72 million, and they bought it responsibly with fixed debt, and they knew what their expenses were, and maybe there's some rough patches, but if they had bought that, held it for 20 years, let's say they had a 20-year mortgage or 25 years for semantics, at the end of 25 years, they would have had a $72 million property that would have presumably appreciated to some extent. So let's just say it's $100 million. Now you have $100 million that's unencumbered by a mortgage, bringing in all that cash flow. It's really hard to actually screw that up. Like, you'd have to really work along the way. You'd have to make some really intentionally bad decisions to screw that up. But it takes 20 to 25 years. It's not get rich quick. It's not. I think you have some experience. You've done this. You've had a few projects where you've done really well on a quick exit, but that wasn't your first one. And it was very opportunistic. So I think you have to be mindful that real estate is risky, and the longer term you have, the better the chances you have of success. But shortcuts, that's maybe the problem that I have with these influencers is that that's how you get successful. That's how you grow a following, is you're trying to tell people that there's ways to get rich quick. And maybe there is, but I don't know anyone that's done it quickly or easy.
It's a combination of the quickness, and you can make money without developing an expertise. That to me is the great lie, because whether it's quick or expertise, it takes time to build expertise. But I talk about this a lot, which is LPs are not any less sophisticated or knowledge than most GPs. They shouldn't be, right? Good LPs are actually really smart, and they're very capable. They're choosing, though, to give their money to somebody else because they choose not to take those steps. But they fully need to understand how to underwrite. They need to know the players. They need to know the risk. They need to know if the numbers on the spreadsheet even make sense for expense assumptions or vacancy, whatever. So the LPs, you really have a lot of work to do. The difference, again, is that work is front-loaded and after you write that check, you ostensibly don't do as much work. And that's the lies. They say it's so easy or it's quick, but they never talk about what you need to develop the expertise to analyze that investment prior to, if it's give it to me, you don't need to do any research. It's just write me the check. Well, I hope some LP can benefit from this, because it is not all roses, and this is the natural pain after a cycle. But people need to bookmark this video. And guys, if we said anything useful, please hit the like button, put a comment, remind people in 3.5 years to watch this video, because the pain that investors are feeling right now is very real. And if we go back in the real estate cycle when there's just euphoria, nobody remembers this pain. It is all so far in the past. We're going to need to drag this video 20, 30, watch this video, and don't make the mistakes. Learn them from the mistakes of people before you. Guaranteed. So same thing. It will happen again. We will be back in this euphoric state of XYZ asset class cannot fail. It's so hot. Just give me money. 2 years. We'll flip this deal. We'll increase the NOI. No problems at all. I guarantee that euphoria will be back. Different asset class, different part of the country. Maybe it's California. Maybe Spencer Pratt wins. They elect Hilton for governor, and it's this, California is back, baby. It's like balanced government. We're gonna build. California prices, cannot come down. Real estate. I don't know. I'm making the bet. Hit that Kalshi market.
I completely agree. That's so eloquently said, because this will be relevant somewhere down the road. We have the benefit of looking at this in after 2020 vision, where it's already transpired. There were people, though, that called this. I saw comments on Twitter of some guy that called this in 2024. He said Brandon Turner is going to lose a lot of money. And I was like, well, that guy was, people should be following this guy. This guy should have his own YouTube channel talking about things like this. This guy's fantastic. We have the benefit of looking after that. But you and I are not trying to sell things. We're if anything, I've publicly said numerous times, I gave an entire speech on this once, that people should not invest in industrial real estate. That's become a hallmark of what I tell people, not to invest in industrial real estate. So I hope people can appreciate that we're coming at this from the standpoint that we have nothing to gain. We're not trying to sell you a course. We're not trying to sell you into a fund that you don't understand and just raising money blindly. This gets under my skin at a level where it's something that I just feel that we have a much smaller voice than what someone like Brandon does, but that doesn't mean that it doesn't deserve to be there. I think we can potentially help somebody out there who is considering investing, and again, make your own decisions. But I would like to think that somebody out there at least gives it a second thought before they give money to someone like Brandon or someone else altogether.
Or just somebody that they are investing with them because they like them, because they're the mentor. Yeah. Those are not the good reasons to invest with somebody. Please invest with somebody because they're the excellent operator, because they have a comparative advantage, because they know this, those are the good reasons to invest. And then the social media following becomes, I would say, less relevant. They could also have a large social media. I mean, I would give money to Ken, who's the Citadel guy, Ken Griffiths.
Yep.
He has a big social media following. I mean, John Gray posts a ton on TikTok now. I would give my money to them, but the social media can't be the leading reason. I believe they have those other attributes. So.
It's a mic drop moment. Well, I'm sure you've got important work to do, and I've got shit posting and memes to make. So we'll wrap it up there, and let's make sure we don't spend as much time in between talking again, because I could easily talk to you about this. We didn't even cover Jacob.
Oh, so yeah, that's another video.
That's another video. So let's tee that one up. That'll be another one that's timeless. So that one's not as time sensitive as this one. But yeah, let's definitely tee this up again. And as always, appreciate every minute I get to spend chatting with you.
All right. Thanks, Chad.
Okay. Thanks, Ron.